Welcome to episode 13 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and deal-by-deal private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Sequoya Borgman of Borgman Capital, a very successful independent sponsor out of Milwaukee. Before we get to it, let's call out what got our attention. Nicholas, what did you think of this conversation with Sequoya?
Borgman Capital is headquartered in Milwaukee, as you said, and they also have an office in Minneapolis. And as they plan for future growth and expansion, you would expect him to suggest Chicago, Dallas, or New York as future hubs. These are the places where you find the highest concentration of talent, capital partners, professional services providers, and deal activity. However, instead of focusing on large metropolitan areas, Sequoya points to cities like Portland, St. Louis, Kansas City, Des Moines, and Omaha. In his view, these markets offer greater strategic advantages, such as less competition for deals, stronger access to local brokers and business owners, and more room to carve out a dominant position. You know, most people in Des Moines are probably not contemplating a career as an independent sponsor. And if they do, they probably wish they were in Dallas or Chicago. But if they listen to this episode, they might learn that being in Des Moines is actually a differentiator and could be their very key to success. So I found this very interesting.
I'm reminded of Nikolai and Ramiro, who are, those interviews are in emerging markets, but the pattern is that more supply, less demand. So being in a market with fewer other sponsors, less competition can by itself be enough of a differentiator to have a lot of success. Max, what did you think?
So Des Moines is the new Bulgaria, basically. I think, Nicholas, your point is excellent and a huge advantage for Sequoya that he's hunting in these kind of second-tier markets, which they're still big markets and there's still plenty of great businesses there. But like you said, maybe a little bit overlooked from the mainstream sponsor's point of view. So interesting. He also brought up that he and Borgman Capital are mostly focused on proprietary deals. There's a point at which he says he gets, 10 to 20 deals across his desk regularly, and they're brokered or bank deals, and he just doesn't see the value to his investors in participating in a process like that. So he's got a huge focus on proprietary deals in secondary markets, which is a huge differentiator. And he's raising from retail, which is exciting because Minds Capital is also raising from retail investors. So it's a huge untapped market. It's, really the largest class of capital in the United States is the retail investor. We know, and Sequoya mentioned and described a little bit what's happening in the PE markets, and the capital's been tied up for a while. Exits are not happening as fast as some of the models forecasted when deals were purchased back in 2020 and in 2021. So we've got capital that's tied up in private equity deals. That's creating sort of a feedback loop where there's less capital now available to raise and to be redeployed. And so where do you go? I mean, the retail investor is a very logical place to look, and he and Borgman Capital have really professionalized that and carved out a niche there, which is, again, it's exciting because I think we're doing the same thing, for a slightly different purpose. One other quick point, I thought this was extremely useful, a great tip for sponsors that my fellow CPA or former CPA mentioned. They over-equitize these deals slightly to put more cash on the balance sheet. I believe he said between $500,000 to $1 million at closing of extra equity just to put on the balance sheet. I've invested in deals where that's the case. It gives you a nice buffer You just never know what's going to happen. He mentions black swan events, but a great tip, put some extra cash on the balance sheet for the uncertainty that may come. Outstanding episode. I thought everybody, Will, Nicholas, you did a great job.
Can I just chime in there a little bit on the retail side? Because I also find this really interesting. And for us in Minds Capital, we started racing retail just because it was our friends and family, and then it evolved that way. And at this point, we're excited and committed about that strategy for our future fund too as well. But the retail financing is kind of a hot topic in private equity in 2025. And you can read about it in the Wall Street Journal regularly these days. You see companies like Moonfair and others coming up that are effectively producing crowdfunding platforms that have existed in real estate previously and to some extent in other asset classes, but not really in private equity. And so there's an evolution here. And you also see companies like BlackRock and Prudential are talking about how if they can get into 401ks, they claim they can democratize access to the private equity asset class for retail investors. And so they're doing this noble thing. But of course, the truth is much more cynical in that 401ks is the motherland for anyone who needs a bigger AUM. And these big private equity companies today are constrained by the lack of exits and the lack of liquidity that they've been able to produce in the last couple of years or so. And so because they haven't been able to produce liquidity, there are two things happening. One is that they need to raise money from elsewhere because their old sources of insurance companies and endowments are now saying, well, hold on, we want to wait before we invest more. And so what is a better source than kind of the infinite pool of retail? And they've seen Robinhood be able to funnel so much cash into the public markets because of retail. And so they're seeing that and trying to unlock that through regulatory changes. And the other thing that we've seen a lot more, of course, in the private equity world is the establishment of secondary funds or continuation funds. So because nobody is buying their companies, private equity companies are effectively selling them to themselves, creating semi-artificial liquidity events by raising funds through an SPV or a new fund in order to sell and exit their old proceeds. And this then keeps the cycle going. So just like a lot of change, a very dynamic capital market. And of course, Sequoia, with what he's doing at Borgman Capital and PassTheHat.com, is playing right into it.
Great color there, Nicholas. Just one other thing on the retail aspect of Sequoia that Sequoia shared that struck me was we keep talking about retail as this untapped pool of capital, which it is. But Sequoia also highlights all these indirect benefits that the firm gets from the ecosystem of retail LPs that they've developed over these 8 odd years. They get ideas from the LPs. They get talent, leads on talent. He'll put a blast out saying that one of the portfolio companies is looking for a head of sales, and they'll get good leads on good talent. Board members, and then of course, deal flow, to your point, Max, about the proprietary deal flow. So aside from just being pure commoditized capital, there seems to be the ability to build an ecosystem as an independent sponsor, if you're at it for long enough, around a base of LPs, a base of retail LPs. And one thing I'll just highlight too, Nicholas, about how we've done it here at Minds Capital, we've done it organically. Their origin story of raising from retail was also organic. You asked him why more independent sponsors don't use a raising from retail strategy, and he says they do. Everybody's first fund is just hammering the phones, calling friends and family, and it's what Sequoia himself said he did for his first deal, and it's actually just grown organically from there. It wasn't actually some grand strategy. He just went with it, and one LP investor would share a connection to a Sequoia with another. So it's just grown organically over these 8 years. And they're now kind of, I guess, doubling down on it with Pass the Hat and trying to kind of maybe put more structure and strategy around it. But just been a very organic strategy for them as well. Anything else, or should we press play?
Press play.
Here is Sequoya Borgman of Borgman Capital for episode 13 of the Minds Capital podcast. Enjoy. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Sequoya Borgman got into deal-making through being a CPA. Tired of seeing his clients have all the fun, he established Borgman Capital in 2017, which is a Milwaukee-based independent sponsor that's acquired 10 platforms and has a team of 13 investment professionals. One of the key features of Borgman is its ability to fundraise from retail. So 500 limited partners have participated across 10 platforms. And Borgman recently launched PassTheHat.com to expand this retail investor network. On average, Borgman reviews about 20 new deals in their weekly investment committee meetings. And that culminates in a deployment pace of 3 to 4 new platforms every year. Sequoya, welcome to the Minds Capital podcast.
Oh, thanks for having me on the podcast.
Well, let's turn our attention first to this retail investor approach. You had only 26, I say only, but you had 26 LPs in your first platform. Today, you have hundreds. How has this approach, this retail investor approach, impacted the types of deals you pursue, how you create value? How does it differentiate your whole kind of approach and strategy versus folks who don't lean so heavily on retail?
Yeah, I think the retail strategy really started from our first deal. Was one of our smaller deals when we first launched in 2017. It was a nice business to own. We were backed by one family office, but we filled in the rest of the capital with about 26 retail investors, as you said, high net worth individuals and smaller family offices. And it's really just grown over the years. Like you said, we have just under 500 LPs have invested with us to this date. And the way retail investors work is when they like having access to the direct opportunities that we're investing in, they'll tell their friends, and then their friends will ask for access, and it just grows from there. And as you said, we recently launched a proprietary platform to more market towards retail investors. I know a lot of the larger funds out there are now raising funds focused on retail investors, primarily through RIAs and wealth managers. But we decided to go direct, and we launched this Pass the Hat platform, really focused on retail investors. We soft launched it last year and really went live earlier this year.
And so the growth of your retailer investor base to date has been kind of organic, natural. One retail investor tells another, correct?
Yeah.
Pre-PassTheHat.com?
Correct. It's all been organic growth through our network, people we know, people that have invested with us in the past. It's just organically grown. And then this is the first attempt at marketing to retail investors outside of our personal networks.
And so your individual deals, platform acquisitions, is what you'll post on PassTheHat.com.
Yeah, deals that are large enough for new investors. Of course, I mean, if anything that we're going to be way oversubscribed for our current investor group, we're not going to offer on this platform. But larger deals will open up to new investors.
And have you done a deal on Pass the Hat yet? Have you gone through the full cycle of acquisition from impersonal retail investors that found the site?
Yeah, we have. Like I said, we went live earlier this year. We have one deal. It's actually about a week away from closing that we got quite a few new retail investors through that Pass the Hat. We got some good press when we launched the Pass the Hat, and a lot of people signed up on it, and we've got some good investors in this new deal.
And so you're promoting Pass the Hat to a broader audience. Obviously, if you're just promoting it to your existing audience, you already know those people. So you did a kind of a PR strategy. I mean, how are you bringing attention to Pass the Hat itself?
Yeah, we got had a few articles in some of the private equity publications that made people aware of it. We've done a few podcasts talking about it, and it's a new strategy. Again, with almost 500 investors to begin with, we're already pretty much retail focused. This really simplifies the process for us. Not only new investors that come through marketing and the Pass the Hat platform, but also current investors when they're talking to somebody that they want to invest with us. It makes that whole onboarding process much easier having this one platform.
Why do you think other independent sponsors aren't using the retail angle as well to the same extent that you are?
I think most independent sponsors do. They call everybody in their network and try and raise the money for the deals. We've just, since we've been doing it for 8 years, we've done 10 platforms, but we've acquired 20 companies, and each one of those add-ons require equity. So we've done quite a few equity raises over that period, and I think just naturally we've grown in the retail sector with our investor base.
And just to hone in on what exactly, or how exactly do you define a retail investor in this setting?
I'd say retail is just a non-institutional investor. Even some small institutional investors that don't have access to direct deals, I would classify as a retail investor. Most family offices, I would say those are retail investors as well. But anyone that wants to get access to alternative investments and direct into private equity, I consider a retail investor. I mean, there's a lot of platforms to invest in venture and early stage investments. There's a lot of platforms to invest in real estate, different real estate sectors, but there's very few platforms that you can invest directly into a private equity, lower middle market, leverage buyout, kind of established business opportunity. I mean, historically, if you want access to a private equity type deal, you would have to invest in a fund, and funds have, as you know, large minimums. So a lot of retail investors just didn't have access, or they didn't know somebody that was launching a new fund, because most established funds, they don't take non-institutional money. So you really have to get in a first-time fund or a smaller lower middle market fund in order to get access historically. And most people don't know those individuals. So that's why we've launched this new platform, just to give a wider audience access to direct investments.
And what are your minimum tickets?
Depends on the deal size, but the smaller deals, the minimums are $50,000, and then it kind of goes up from there. Larger deals, of course, we can't have 1,000 investors in a deal, so we try and keep it around 100 or less. So whatever the equity size is, we usually divide by 100.
For me, one of the issues is the timeline, right? So we talked about venture investing and angel investors. When you're racing for a seed round or a Series A, you have some time, not years, but several months. As an independent sponsor, you're under an LOI, typically one that expires within the next 60 to 90 days. And so you have a very short window for fundraising. And if you need $10 million of equity, let's say, and you're going to raise that from people with $50,000 checks, that's going to take a lot of time, especially if you're required to do one-on-one meetings. So how are you able to, solicit so many investors in such a short amount of time and get them all the way to the commitment?
Yeah, we compress the commitment period. We've kind of learned that over the life cycle of our firm is you can't give them a lot of time. And again, we've been oversubscribed on every one of our deals since the first one. I personally invest, and my partners personally invest a great deal of the equity in these deals. And the more liquidity we've received on exits, just the more we roll in. So some of the deals we did last year, I was the largest investor, the second largest investor. So normally once we get a company under LOI, about 2 weeks after that, we'll have an offering memorandum and the investment deck all pulled together. We'll send that out to our current investors, the 500 or so, or anybody that have signed up on Pass the Hat to see our opportunities. And then we'll give them a week to review that. We'll do a investor presentation about a week in, and then we'll give them 7 to 10 days to make a commitment. So that we're 30 days in for the deal. And if it's a 60-day timeline, although timelines are extended right now, so I'd say probably 90 days. But 30 days in, we'll know who has an interest and who wants to invest. And then we'll send out the formal subscription documents, all the accredited investor checks, and the formal wire information, all that kind of stuff, and give those investors 30 days to return those, wire the funds, and then we usually have about 2 weeks before we close the deal after that, those funds come in. And we found that that's the best way to work the process. Originally, we would give investors 30 days or longer to make a commitment and do their diligence, and diligence us, of course, as well. But that really puts pressure on getting the equity in time to close the deal. So they have a shorter period, and we recognize there's many sophisticated investors that just need longer time, and they're not going to be able to participate in these opportunities unless they've participated in previous opportunities. And they usually are able to work around, and we do full diligence on all of our opportunities, and we have a data room that's available for the investors that want to dig in and do their detailed diligence as well. And that's all available in that usually 7 to 10 day timeline.
So it seems like a very self-confident approach to set such a tight timeline on, hey, here's the memo, we're raising money from you, but you have an exploding timeline on it. Do you get any pushback on it, or how much shorter could you make that timeline realistically before it really started to repel people?
We're oversubscribed. So if we needed investors, of course, we would extend the period but we've never had to do that. Like I said, the first deal, we worked it very hard to line up the money. And then since then it's been, and again, it's all about the opportunity. And first off, I mean, we have to like it personally. It has to be a great personal investment for me and my partners. And if it is, and we have conviction around the opportunity, it seems like it's easier to get our LPs on board as well.
It sounded like you reached out to investors pretty early on after signing the LOI. Now, how do you communicate when you have so many investors who are putting money on the line? How do you communicate if something material was to come up during your due diligence process, for instance, after they have committed?
Yeah, we try and over-communicate with all the investors, and we have had opportunities. We had a deal last year that during the diligence period, their numbers deteriorated, and we did not close that opportunity. And we kept the investors, even after they had committed to the deal, we kept them in the loop that we extended the period, we extended the QV, we did a follow-on QV, and ultimately decided to just walk away from that opportunity. So that does happen, but we just keep the investors in the loop, make sure that they're aware of what's going on. Not every transaction, once you get in and do the diligence, and is exactly what you think. And I think several times that's happened, that we've had to either walk away from transactions or retrade transactions. And I mean, we try to avoid that, but it does happen from time to time.
And you mean after you're fully subscribed as well then, right?
Right, after we fully subscribed.
I imagine it builds the trust factor even more in a way with these people in your database who have known you across multiple deals. If they see you work deals even after they commit and be very transparent about it, it must help the next time around, right?
Yeah, it does. It does. And also the fact that we are oversubscribed. I mean, investors know that if they do want to get access to it, they need to get in early and let us know if they have an interest. We've never called money and then had to return money on a deal. Like, we'll do all the diligence and have the QOV. We might not have the full report, but we'll have the draft report before and we'll have the term sheets from the banks. So we're very confident on the structure and financing and equity needs before we go out to any investors. We don't want to go out and then have to change the terms or change the structure, or change the IRR expectations, any of that type of stuff. So sometimes we'll even go out later in the process. We have another company on their LOI right now that it's a slower process. It's kind of a proprietary deal where we just want to be very, very confident around the numbers before we really go out to our investors. So that one will probably go out 30 plus days into the process.
Okay, so there is some flexibility there on the timeline, because I think initially you said about 2 weeks in, you'll send out the memo. But it sounds like there are two big milestones that you're looking to get done and completed before you reach out to equity investors. And the first one was a soft verification of the numbers, some draft of the QFE, and the other one was a term sheet from a bank, so that you have solidified the sources and uses a little bit.
Yeah, we want the whole cap table pretty much set. I mean, things do change throughout the diligence period, and but for the most part, we don't want to have to and most of the deals we do, we actually pull a little bit of extra capital. We'll either put the money on the balance sheet when we close, or overcapitalize the business slightly, just in case things do change throughout that period. But and I feel like, I mean, it's not like the deal frenzy of 2 years ago when deals were getting done in 60 days or less. I mean, now we have time. Most of our LOIs are 90 days with a 15-day automatic extension. So you really have about 105 days to get the deal done. I feel like that's plenty of time.
You mentioned there that you overcapitalize your businesses. By how much would you say? Can you give us a numerical example of what you would recommend?
It's not a huge amount. It's usually, I'd say, 500,000 to $1 million, just in case transaction fees, diligence fees come in higher than expected, in case working capital isn't where you expect it to be at close. I mean, there are swings in working capital, and maybe you need a little bit of more cash on the balance sheet when you close. There's those types of unexpected things. I mean, you can't really time where the working capital on the business is going to be 90 days before you close. So we like to just leave a little bit more room. And most deals, I mean, most of our deals are in the 25, 30 to $50 million range. I mean, another 500,000 or $1 million doesn't really move the needle on the IRR.
Right.
Sequoya, the raising from retail, that whole strategy, and you're doubling down on it. I mean, you're trying to do it more. It would seem that given your track record now, starting in 2017, so much success since then, your access to capital would have gotten only easier over these last 8 years. And it would seem to be it would seem to be easier to work with institutional capital rather than the herding cats of retail investors. So why, as access to capital has become easier for Borgman, are you actually doubling down on the retail strategy?
Yeah, I think there's multiple benefits of having the retail investors, and most firms at this stage would have raised a first-time fund by now, and we've decided not to do that. Really, one of the reasons is a lot of our leads and opportunities come through our investor network. With, like I said, almost 500 investors. I mean, they tell us when they hear of somebody that wants to sell their business, so we get proprietary leads through that. A lot of the board members that sit on our companies are investors. And then every quarter when we send out an investor update, we always have an ask. So if the companies need a new sales lead, or need a new CFO, or they need an introduction to a new customer, we put those in those reports, and it's amazing about how well connected our investors are. Most of our investors are very successful business owners, entrepreneurs that have made their majority of their wealth from owning equity in a business, and that really helps our business. I mean, if you have 500 people that are really watching out and trying to make the companies as successful as possible, it helps the investment, and also the flexibility. I mean, really, as an independent sponsor, one of the biggest values you add is finding proprietary, off-market, non-competitive investment bank process businesses, and you're able to do that and be flexible without the restrictions of having a fund structure.
Fascinating. So the size of the retail base just really adds indirect value in all these other ways: deal flow, talent, connections.
Yeah, and I enjoy it when our investors call me and give me ideas on. Again, they're all very successful. They've got great ideas of how to grow the businesses, how to make the businesses more successful, who we should put on the board, who should be leading these businesses. I mean, if you have 500 people that have skin in the game and want these businesses to be more successful, nothing against institutional investors, but that's really not their focus. Their focus is get the highest return possible, which is the same for our investors, but they don't have the value add side of the equation. And we're pretty much a retail group at this point anyways, and we're already dealing with thousands and thousands of K1s and I mean, with 500 investors and everything that comes along with that. And we built out the back office side of our business to handle that at this point. So that's less of a concern.
Great, Sequoia. And just last question before we move off the topic of retail. Just you had mentioned how some of the bigger firms are even making retail offerings. Give us 60 seconds on what you see broadly in this trend of you and much larger players offering access to the private equity asset class to retail. What's the trend, and if you describe it?
Well, I mean, the Blackstones and KKRs and Carlyles of the world have raised these large retail funds, and that's, I mean, one of the reasons is it's harder and harder to raise funds from institutional investors right now. They're just not getting the liquidity that they were getting a couple of years ago. They're deploying less into new managers. They're deploying less into private equity overall because they're highly concentrated as it is. I mean, private equity allocations have increased significantly over the last decade, and given this kind of slowdown in exit processes right now, that liquidity is not there. So I think the large funds are looking at retail investors as access to additional capital, and retail investors do want access to this. I mean, it shouldn't just be for institutional investors, and so. I mean, there is a want on the retail investor side, and I think there's a need on the funds as well. And again, we're on the smaller side, of course, but our investors really like having access to these types of investments.
And are you seeing other sponsors take a similar approach?
Yeah, since like I said, we got a little bit of press around our launch. I mean, there's been half a dozen or more that have reached out to me that are in the process of pursuing similar strategies. I think that that will become more popular here in the near term. Again, the last decade, there was so much investors that want access to private equity that it was less of a need. And once you raise a fund, I mean, there's really no reason to tap the retail market, because, like you said, it's rather than having 10 LPs or 20 LPs to deal with, dealing with 500 LPs is quite a lot of administrative work. And I mean, fortunately, we've already built out that side of the business, so we can handle that, and we do rely heavily on the new technology. With, like I said, Asset Class handles most of the back office for us, and Invest Ready and some of the other kind of online opportunities makes this process a lot easier than it was 5 or 10 years ago.
Sure. And are you guys considering Pass the Hat as some sort of white labeled offering to other sponsors? I mean, is this something that becomes a product that's not just a way for your fund to raise? Excuse me, for Borgman to raise, not a fund?
No, I don't think that's the strategy. And there are some SEC restrictions around doing something along that. We're not a RAA. Sure. We're not a placement agent. We're not raising money for other groups. We do full diligence. These are our sponsored deals. We have partnered with other groups. I mean, if we're a partner or a co-GP, or we're the GP on a deal, we would of course welcome to do that. We would partner with other independent sponsors that want to get a deal close and need some help on the equity side. But we have to be part of that general partner pool in order to do that. We really need to. And again, we're responsible for all of our investors' money. We don't want to do stuff on a kind of a non-control basis is really where it comes to.
Thank you for that, Sequoia. Really, really great to hear kind of behind the scenes on retail firm. Let's turn our attention to deal flow and your kind of funnel. How are you guys generating deal flow? Anything to say there? Any differentiation from how other sponsors are doing it? You'd mentioned already your retail, your retail base brings you some deals.
Yeah, our investors bring us some deals. I mean, it's really our network is what we've got an office here in Milwaukee. We've got an office in Minneapolis, really focused on deal flow. We just added a new MD last year out in Portland. From my standpoint, really all the independent sponsors, where the biggest value is finding nice off-market opportunities, and anybody that can source those really can add some value on the investor side. So that's really our focus. We'd love to add more people around the country that can source these lower middle market direct opportunities. But that's where most of our deals come in, is really either through our network or COIs, trusted advisors to these business owners. And then we do look at some of the brokered deals, the investment bank deals. We really only focus on the ones where it's either in our market directly, we have an angle, either we've already bought a company in that space, or it'd be an add-on, or we know the investment banker really well. If not, we don't participate in really the competitive auction processes.
So most of your platforms have been proprietary?
Yeah, I'd say 85% have been, I mean, there's only been maybe one or two that have been a kind of a blind auction professional investment bank process.
Can you talk more about what role geography plays here? You mentioned that you open an office in Minneapolis, you're in Milwaukee, you had someone in Portland. I think on our pre-call you mentioned a couple of other cities. These were not your New York, Dallas, San Franciscos of the world. So how are you thinking about that?
Yeah, I think the opportunities are in the secondary markets where deals can get done directly, where relationships and networks really matter. That's less so in those big markets that are, I mean, Chicago probably has 250 private equity firms. New York has a multiple of that. I mean, you're not going to find many off-market proprietary deals in those. But the secondary cities throughout, like Minneapolis's and Milwaukee's and St. Louis's, Kansas City's, these secondary markets around the country where it really does matter. If you know somebody and they introduce you to a business owner, that's where the best opportunities come along. It's not that you're necessarily paying less for the business, but you have a much higher likelihood of closing that opportunity and winning that deal if you have a relationship with that business owner already. You still have to pay a fair price, but like I said, you spend a lot of money and time and effort anytime you go after a business, and the likelihood of getting something under LOI really matters. So, I mean, we only have so much time in a day, in a year, and if we're attending 20 management meetings, I mean, it costs $5,000 to $10,000 every time you go to those. If you fly in the group and you do some diligence and do some research around that, so it's costly to go to all these, and you want to spend your time and your resource and your efforts around opportunities that you can actually win at fair prices.
So this seems like a differentiation point, because most deal makers sit in Dallas or New York or Chicago and can do deal sourcing from there nationwide. But you've taken the view that our ability to source more deals and our closing rate will be higher if we have a local presence.
Yeah, I feel like at least in the markets I'm in, it does matter to be all the deal professionals in your local market. You're personal friends with them. You sit on the boards of organizations and charities with them, and that's who's gonna if they're aware of a business that's for sale or it's the business owner directly. I mean, they're going to be more likely to talk to you than they are to somebody out of New York or Chicago or Atlanta, LA, one of the larger, Dallas, one of the larger areas. It does matter.
There seems to be a link here between local presence in the community, and also on the investor side, you have the retail approach where you have just a lot of touch points and connections. Would you say they are a little bit analogous and they go nicely hand in hand?
Yeah, of course. I mean, my whole career, and I tell our group quite a bit that your network is your net worth. So I mean, really in this business, more than anything, the better network you have, the more people you know, the better connected you are in the deal community, the more likely you are to find these nice businesses at the right time. I mean, most business owners, they only sell once, or maybe they'll roll over and sell a second time. But so you really have to be right place, right time, and in order to find these opportunities. And sometimes these family businesses, they sell once in 100 years. I mean, it could be a third generation family business. You really have to be there when they're ready, and those opportunities really just come through your network. Of course, I can sit at my desk and I get 20 emails a day from investment banks about deals and companies that are for sale, just like everybody else. I mean, all over the country. I mean, we track them. We get about 1,500 of those a year. But that doesn't add a lot of value to the investor group. If you're going through a competitive blind auction process, unless you really have a really good thesis or you really can add some value to that business, paying up doesn't provide any real value to your investors. And again, I'm personally investing in these myself, so I'd much rather invest in a business that I know the owner, I trust him, he wants what's best for his business, he thinks about his legacy, thinks about his local community, and we've shook hands, looked each other in the eye, and I know that post transaction he's going to want the business to be just as successful as I do, rather than going through a blind auction process where there's kind of a Chinese wall, and you really get to know that owner after you send him a giant check. That's not the types of opportunities that I personally enjoy investing in.
Sequoya, say more about the playbook of putting boots on the ground in a new market for Borgman. So and maybe specifically, I'll presume you find somebody who's already very networked in that community, as opposed to dispatching somebody from Milwaukee. Correct me if I'm wrong. And then what is the playbook there, and maybe even compensation? How do you compensate such a person? Are they kind of a BD person? What does all that look like?
Yeah, great question. So we've added a few people, but I'd love to add more people that really want to do kind of deal by deal, independent sponsors that want to do it on their own, but they want some infrastructure, they want some backing, they don't want to start from scratch, because it's tough being an independent sponsor. I mean, we went through that. You don't make any money for your first 2, 3, 4, 5 years. You've got to cover all the overhead, cover all the diligence costs, all the broken deal costs, and then not only do you have to be working through diligence after you find a company, you also have to be raising the money. I mean, there's a lot of independent sponsors that either don't find a deal or they're not able to close that deal because either terms aren't right or they just don't have the network to raise the money. So the way I look at it, we have that platform. We've gone through that startup period. We have all the infrastructure. We have the back office support. We have all the diligence resources, and it's a bigger group. So, I mean, we can go through kind of the whole investment committee process on that deal. It's not one person making a decision if it makes sense. So for my picture, we've got the platform, and we'd love to have more people that want to help source opportunities around the country. And I want to move somebody to a new geography, because I mean, you're not networked in that geography unless you really grew up in that location, or at least worked in that location quite a few years. So we're looking for people that are already networked, that can source deals, but want some resources and don't want to be a one-man band. They want to be part of a larger group that already has some resources and can get deals done. Again, we've never come up short on a deal. We've done 20 deals, and all except the first one was oversubscribed. That first one, I was calling everybody I knew to try and get the last money. And that most independent sponsors, they go through that same process. So that's really what we're looking for, is people that want to do what we're doing but don't want to do it on themselves. And I mean, truthfully, we'll help cover some overhead and help cover some of those broken deal costs and all the kind of travel and a lot of those costs that you incur in the first couple of years. But most of their compensation is based on being successful and sourcing deals and getting part of the closing fee and part of the management fee and a good chunk of the carry once that closes. So they can do very well. And they have more certainty of closing that opportunity because, again, you can, if you're an independent sponsor and you leave a group or leave something you're doing, I mean, sometimes it takes 2 years before you source that first deal. And you could incur hundreds of thousands of dollars in diligence costs and costs in that period. And if you're not successful, that all comes out of your pocket. So we kind of give them some downside risk and help them be more successful. And in exchange, they share some of the upside with us.
And is this it almost sounds like a program that you've got going, Sequoya. I mean, if somebody listening is in some market that you haven't mentioned, should they come knocking and say, hey, I'll stand this up in Seattle? Or are you all deciding on a geography you want to go into and then you look for new or kind of less mature sponsors in that market and say, hey, come join Borgman?
No, we're very opportunistic. It's more about the person than the geography. So if anybody listening that is thinking about doing what we're doing, and I know a lot of people would love to do it. It's I have to warn you, it's a lot more difficult and stressful than most people think. I wish I'd known that 10 years ago before I'd launched, but it is a lot of fun as well. But if people are thinking about doing that, please reach out to me.
And so do you give them a base salary as a business development hire, or is it all commission based, but just you help improve the chances of success and you cover deal costs and so forth?
It's primarily commission based. Sometimes we'll help with healthcare or things like that if they need something, or there's some extra kind of extraordinary circumstances that they need some help with. But for the most part, right, it's instead of doing it on themselves where they get paid nothing and have to cover all the costs, we'll help with the costs, but it's really upon them. If they're not successful in sourcing deals, it's not going to be a good opportunity for us or them.
And I have to imagine that not only can you help them close the deal, but it's helpful for them in sourcing deals to have an email address that says borgmancapital.com.
Yeah, I mean, I know when I was first launching, legitimacy, I mean, business owners want to know that you're legitimate, that you can get the deal closed. Brokers, the same way. They're trusted advisors or their accountants and attorneys. They're not going to tell a business owner to sell to somebody that has no business card, no website, and has never done a deal. So that's a big hurdle to overcome, and we can help with all that. I mean, give people the legitimacy of having a track record, doing deals, just the business card and the website alone. I mean, that's the first thing people check when you talk to a business owner.
You know, it's really analogous into search land, which is, I have a podcast on more the ETA side, to kind of traditional search funds versus self-funded search, where the traditional search funds, if you go that route, brings some legitimacy, it brings infrastructure, really knowledgeable people at your back. You don't have to self-fund your own search versus self-funded, where you're completely on your own. So it's in that kind of those two paths in search land are very built out, and it's something that a prospective searcher really asks himself which path he's going to go. I don't see that as much in sponsor land, but it sounds like you're providing something here that might be analogous to not terms wise, but to some of the benefits of doing a traditional search fund versus going completely self-funded. It's pretty interesting.
Yeah, I love those search fund guys. I wish that was an option when I was coming out of college, but it really wasn't a thing way back then. And I talked to a lot of the guys coming out of the MBA schools. They're doing the searches for 1 or 2 years, because if they find something that's too big, maybe for them to do themselves, we'd love to partner with those types of guys. And we run across a lot of stuff that's smaller too that we'll send to them, and I may personally invest in it if they're doing something. But there is a lot of overlap. And same with the larger PE firms that are above market for us. Maybe we would partner with them or send them something, and they send us stuff that's too small for them to look at for a new platform. I mean, I encourage everybody to be networked within the industry, both the groups that are a little down market from you and the ones that are up market from you.
You mentioned earlier that if you had known how stressful being an independent sponsor was, you wish you had known that before you started 10 years ago. How would it have affected your decision making?
I don't think I would have decided.
Still be a CPA?
No, that's maybe less stress, but a lot less enjoyable as well. So no, it wouldn't have impacted my. But everybody, I mean, we talk to a lot of people that want to get into and do what we're doing, and it's not as easy as people think. I mean, it's businesses don't just go straight up after you buy them. There's a lot of challenges and people issues, and hiring the right people and putting the right people in the seats on the bus is very, very challenging. And you work through these economic cycles. I mean, there's a lot of stress in owning and managing these lower middle market businesses.
Jensen Huang, the founder of NVIDIA, he keeps saying this more or less same thing, that if I knew how hard it was to be an entrepreneur, I never would have started this company. But I honestly find it hard to believe, given where he's gotten to by now, and he looks like he's having so much fun. So it's just a paradoxical statement to me, that one from him anyway. Earlier in the conversation, you lightly touched upon why you prefer to be a sponsor versus raising a fund, which you obviously would be equipped to do at this stage. Could you double click on that statement and really make the case for why staying a sponsor long term can be better, maybe financially, emotionally, lifestyle flexibility wise? I would love to hear more.
Yeah, I mean, it's a lot of people ask, and we discuss it internally every time we have a strategy session. Half of the time is spent on should we raise a fund or should we not raise a fund. It's a big, because there are some upside, especially for the younger people on the group. From my standpoint, it would have been really nice to have a fund and that consistent management fee to pay for the overhead when we were first launching. But now we've gotten through that hurdle, that hump, and truthfully, there's more upside for me on doing deal by deal. As you know, the way that carry works, we can have some very successful deals, and we can exit early and get our carry back in an earlier position, and you're not tied up by a 10-year fund, and you're not tied into one fund mandate. As you can see, the investments we've made have been, they're kind of all older industry, manufacturing, distribution, food type investments, but it's not like we're just investing in one sector, healthcare or whatever your fund mandate is, and we're not tied to one geography. We can be very opportunistic around structure. Most of our deals have been leveraged buyouts, but we've done a couple more kind of growth equity type investments. We wouldn't be able to do that if we had a fund mandate that only allowed us to do one thing. And I can personally invest in deals outside of our group that I would be restricted from doing in a fund.
Yeah.
And I like what we're doing. I mean, like I said earlier in the podcast, the more money I make on exits, the more I roll into the next. And I think long term, that's what I'd love to do, not necessarily more of a family office focus, because I do like having the resources of a bigger group. But I mean, ultimately, I'd love to be a much larger investor in each one of these deals. I've drank the Kool-Aid. I love kind of what we're investing in, and I can do that without doing the fund route.
You know, it's interesting, Sequoya, that so many sponsors confront this question, especially as they get more mature, some successes under their belt, should they raise a fund? And then many, of course, do. But it's actually precisely when you've gotten success and built a track record and gotten through some of those early hurdles as a sponsor that that a lot of the weaknesses of being an independent sponsor, the lack of credibility or legitimacy, maybe by the other side of the table, or struggling to raise capital for every new platform, go away. So it's almost like as you're a bigger, more successful sponsor, that's precisely when raising a fund would become less interesting, because the problems that raising a fund solves, you no longer have. And I think you're a perfect example of this.
No, you hit the nail on the head. Then you have the pressures and the stress of having a fund and having large institutional investors putting pressure on you, and also, I mean, you have that pressure of having to deploy capital. Like right now, It's very difficult to deploy capital, especially if you have a $500 million to $1 billion fund. I mean, that's a lot of capital you have to deploy on an annual basis. And given the slowdown in the deal flow this year, the last 12 months, I mean, that is extremely difficult to do. So, I mean, the individuals, the friends that I have with funds, I mean, they're under a lot of pressure right now.
Yeah.
You said that it comes up monthly in your strategy meeting whether or not you should raise a fund. Who is pressuring or advocating for it?
I think it's the younger groups, younger individuals. We can add more resources if we had a fund, just because of that steady management fee that's coming in, and it's more, I'd say, upside for the newer individuals. They don't have, like, a lot of the wealth I'm creating is investing my personal income and personal wealth into these deals, where the younger generations, the younger people on our team, they don't have that net worth to invest in the deals personally. So most of their upside is the carry that they're getting at the end of a deal. They're not getting the return on the investment like I am and some of my more established partners are. So I think the pressure is more on the younger team members, that a fund structure would probably be a little bit better results for them.
Sequoya, we're getting toward the end of our time together, but wanted to hear about a particular deal of yours. We talked about the equipment rental business in our pre-call. Can you give us the bullet points of that story?
Yeah, I'd be happy to. Most of our deals are confidential, but that one we did sell to a public company, Herc Rentals. So that information is public. But that was a great investment for us. We bought it from a founder who had grown and led the business for 40 years. Great individual. He sold to us kind of an off-market opportunity that came to us through a banker that we knew, and really the reason that deal did so well is we found the perfect successor for that founder. That founder wanted to retire, spend more time playing golf, and we brought in an industry veteran that knew that business inside and out, and he just did a fantastic job. We added locations to that business, and he really grew it. He doubled the EBITDA within 3 years, and we decided to sell. One thing my philosophy is, if you have a home run, don't get greedy, don't hold on too long. And so we sold just a little after 3 years on that company. 3 years, we got some better tax treatment by holding 3 years. I mean, it really took off within the first year, and second year was great. Third year was tremendous. We sold, like I said, to a large public company, and the investors netted a little over 4 times their money on that investment, and it was over a 57% IRR on an annual basis for that. So I did very well. My partners did very well. Everybody that participated in that opportunity did very well. And if we could just find more companies like that, this would be easy.
Or is it Sequoya finding more leadership like that? Because you'd said to us in the pre-call that so much of and I think you just said it, so much of the success of this story came down to the operator that you found, the leader of that business. You also had said, though, that as much rigor as you apply to who you hire to put into your platforms, to lead your platforms, your hit rate of hiring the right person is only about 50%. So say more about that. This person was the right person for the right business, and it was in the happy 50%. But you still haven't cracked the code on improving that record of hiring the right person.
Yeah, if somebody knows the secret to that, give me a call. It's very difficult when you're buying founder or family-led businesses and you have to transition to a new leader. That's the biggest risk really on that investment, is that transition does not go very well, that you bring in somebody that doesn't align culturally with that business, or somebody that may have been very successful in a previous role or running a division of a large company, but they just do not understand the intricacies of that business or of running a lower middle market business where you don't have the resources that most businesses do. And not just a leadership role. Anytime you're hiring somebody, I mean, they may look very well on paper, and they may interview great, and you go through all the processes and do the cultural assessments and everything that you can do. And then a lot of times it's, soon after hiring them, it's just a poor hire. They're not the right fit. Maybe their management team kind of balks and pushes back and doesn't support them, and then the company doesn't do as well. And that's happened to us quite a few times. I mean, unfortunately, that's part of what we have to do is do the right thing for the business. And a lot of times we'll have to bring in a new leader. But that particular business, I mean, we had the perfect leader. He was a born salesman. He really just almost had to rein him back. He was growing so fast and so much, which that's a better process to have than when you're really pushing a leader on a business, or having them. I wouldn't say we're micromanagers, but we are very involved in the business, and the leaders that you have to get really involved and really kind of push and really hold accountable. Those are tougher investments, and they're not as fun.
Can you share what the EBITDA was when you bought it and how that developed?
Yeah, I think when we bought it, it was around $4.5 million at EBITDA, and around $9 million when we sold it 3 years later.
So 3 years, wow. And you said something earlier there that when you have a home run, you said don't get greedy, cash out. Other investors will say when you have a winner, ride it and hold on to those. So philosophically, how do you reconcile those two philosophies?
Yeah, they are two different philosophies. I mean, there is some benefit in leaving some upside for the next buyer. So that's why I feel like, and the IRRs go down the longer you hold a business, even if it's a home run. I mean, if you hold it 3 years, your IRR is going to be a whole lot higher than if you hold it 10 years, even that if it's a successful business. Cash on cash returns, that matters more to some investors, but there's risks. I mean, all these businesses, they don't go, it's not a straight line. I mean, it's ups and downs. I mean, we don't invest in real cyclical businesses, but every business we have had 1 year where there's some type of challenge they're facing. Either it's turnover in a customer or a supplier or a key employee or some outside macroeconomic challenge they're facing, like tariffs right now. I mean, there's always something, COVID, supply chain, you name it, and you can't foresee what those black swans are going to be. So my philosophy is if you do have a really nice, doesn't even have to be a home run, if you have a good second base or third base, I mean, once you've professionalized that business and it's time to sell. I mean, depending on the market, you're not going to sell in a down market, but if it's a good market and a good time to sell, just take the money and then you can roll that into the next opportunity.
You mentioned that you had sold it just after the 3-year mark because you could get better tax treatment. And I presume you're talking about carried interest, which at the 3-year mark, it goes from being taxed at as short-term gains and income tax, roughly 40%, to being long-term capital gains at 23.8%. Is that correct?
Yeah, that's correct. In Trump's first term, he changed capital gain treatment for carry from 1 year to 3 years. So from ordinary income treatment to capital gain after 3 years. And a lot of our deals, any deal under $50 million, we try and structure as qualified small business stock. So it's Section 1202. So that's even better treatment. If we hold a company 5 years, you may potentially owe no capital gains tax on that investment.
You mean QSBS, right?
Correct.
Then you have to hold it for at least 5 years, and there are several other requirements, right?
Right.
It has been proposed recently that carried interest will be removed as a special tax haven, or it'll be taxed as ordinary income. As a CPA and someone in the game, what if that happens? What will be the workarounds?
Again, being a former CPA, I don't think there's many workarounds. You pay your taxes, be happy that you're making money. It's always better to make the money and pay the taxes than try and work around it. But I think carried interest has been under attack for decades. I mean, it's not a new thing. So I mean, it did get like extended from one year to 3 years under the previous Trump regime, and I think it'll be under attack again this go around. So we'll see how it ends up.
I have heard it's what Congress does when they need more donations. They go and shake that tree and say they're going to touch carried interest, and then they get a lot of donors to send them money.
Well, fortunately, there's a lot more successful big private equity guys that can afford to do that.
Sequoya, anything you wanted to share with our audience that we didn't hit on?
No, this has been great. I enjoy the conversation. I'm really excited to continue to see the growth in the independent sponsored sector. It's really come a long way over the last decade, and there's a lot more resources available than when I was launching. So I again, reach out to me if anybody wants to partner up on a deal. We're always looking for good investment opportunities. Great.
Well, we'll have your LinkedIn and URLs and email if you like in the show notes, and people can reach out to you that way.
Great.
Sequoya Borgman, thank you for joining us on the Minds Capital podcast.
Thank you.
Hope you enjoyed that interview. For more like it, subscribe to Meeting of the Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraisers. See you in the next episode.